Hi, my name's Sean. Welcome to the UHY Brexit VAT and Customs webinar. We're having some IT problems, which is probably inevitable. So the webcams aren't working, a bit early for me. If they do start to work during the broadcast, don't be frightened. What I do is just run through some of the housekeeping. So we can move to the next slide, please. So for everybody's awareness, obviously there are issues with webinars and meetings online with microphones not being muted. Hopefully we have control of that, so everybody's microphones are muted other than the presenters. The webinar is being recorded, so you can access this at a later date. It will be posted on the UHY website. UHY will issue 2 post-event surveys to all attendees. One is a collaboration with the Times newspaper. We're working with them really to establish the extent of the impact of Brexit for clients. So if you could complete that, that'd be really helpful. The second survey is a standard survey, which really is just feedback on this event. So, you know, was it okay? Did it meet your expectations? Have we delivered? And it's part of our continuous improvement, so very important to us. So if you could complete those, I'd be really grateful. At the end of the session, we'll have a question and answer, which again, technology hopefully won't defeat us. Where we are with that is that if you can send questions via the chat box, they will come through to us. We won't answer questions during the course of the presentation because it would disrupt, and I think we would probably be here for the next few weeks. So we'll answer as many questions at the end as we can. We will try and choose questions that reflect on many of the issues that we've discussed. And I would say just a word of caveat really that there is no way that we can answer every question, every permutation. We're doing the best in this presentation really to outline the key issues. And for most clients, it's working through to a solution from rules that really aren't complete. And I think it's evident from the press and everything else that this has been quite a painful exit from the EU. Okay, next slide, please. So by way of introduction, my name's Sean. I'm the VAT partner at UHY. Originally trained to be a lawyer. I joined Customs and Excise as a senior officer way back when. And things come full circle with the EU. So I spent most of my career in the Big Four before joining UHY, which has been a pleasant experience. I'm absolutely delighted to have Barbara co-present today. Barbara works with us as an external consultant, so she works with our clients and directly with us, which is fantastic. Barbara is the head of the Customs Practitioners Group with the Chartered Institute of Taxation, direct access, from what I can see, to many of the senior customs policy people. So absolutely delighted that she could join us today. Next slide, please. So what we will cover. In a way, we're trying to tell a story here. So we'll set out the background to Brexit, so how we got to where we are today. Barbara will run through the customs consequences. I will cover off the VAT issues that have arisen really from Brexit. We'll try and provide some solutions, because what I've seen from a lot of other presenters is really kind of these are the issues and go and sort them out. So we have developed solutions with clients. There are things out there. So kind of some of the fixes that might work for you guys. That'll be followed by the Q&A, which I've discussed. And what we'll also provide is access or links to a few information sources. So that really is to give people access to guidance that they can do some of their own research, that they can look into the different issues. There's a lot of information out there, some of it contradictory. So going to the right source is really important. So I hope that will give us a kind of story, a kind of feel for Brexit, which has been quite tumultuous, very difficult for advisors and obviously mainly and principally for businesses to get through and around. And I think in our experience as well, the revenue have been shocked and really kind of out of sorts with this. They've been unable to really to answer many of the questions that we've put forward or have been put forward. Okay, next slide, please. So the timeline. So against expectations, the UK voted to leave the EU on the 23rd of June. I think working in London, the mood was very, very somber because there was a real realization that this had ended quite a trade facilitation with Europe. And the years that followed obviously were very acrimonious in terms of the different sides and everything else. And then we reached the transitional period, which wasn't quite what it said. What we'd hoped for then was negotiation, that we'd have a deal, and transition should have been to allow businesses to understand what was coming on the 1st of January, and that didn't happen. I think that the thing for me, I mean, we had the trade and cooperation agreement on 24th December, Christmas Eve, which was a bit of a Christmas present. I was delighted. I think my dread was that we'd have WTO, World Trade Organization terms for tariffs. You'd have tariff barriers, which is not what trade wants. It was going to hurt business. It was going to hurt everybody. It would hurt the economies. So it was great news. And then as you got into the detail, we uncovered, and businesses uncovered a lot of blockers there, in particular country of origin, which Barbara will talk about, which reintroduces tariffs. We knew customs procedures would be in place. They are onerous. The revenue have invested, I think, 50 or 60 million trying to train customs agents over the transitional period. I don't know how well that went, because it doesn't feel like it's been a success. And on the 1st of January, the brave new world, where everybody really is trying to understand how you implement now these new procedures. And I think the revenue have been caught out. Certainly, clients have found it difficult. We found it difficult. Guidance takes us 60% of the way there. It's difficult to get a response or a ruling from the revenue. Let's see if they'll even reply. We are governed by the agreement that is in place. There is a mechanism to revisit areas of that, but the committee that is set up to do that isn't even in place yet, and it's not going to happen for many years. So really, as the government says, this is a bedding in period. This is a period where businesses get used to the changes, and we'll see what happens in due course. Okay, next slide, please. So just a few brief headlines. So frictionless trade, I think probably some consensus that isn't really a truism. So we've mentioned the free trade agreement. The revenue announced recently that 900 million in tariffs are not going to be collected, which shows again there will be tariffs between the EU and the UK. They've issued 190k in fines, as £100 per fine to drivers for incomplete paperwork. Companies have said they've been advised by government to set up in the EU, and we have seen some evidence of that. It's not official guidance, but clearly it's a kind of practical answer. We're seeing inland customs points, which is very unusual. I've only ever seen that before, probably in Ireland. And so near me in North Wales, there's a customs point there where lorries can check in, clear the documentation, then drive down to Folkestone and Dover and move on from there. Suspension of trade, so some businesses have just stopped trading with Europe while they kind of sort out the mess and get some kind of clarity on what they're supposed to be doing and allow goods to move. There have been particular issues in Northern Ireland, which has been complete fudge. Second-hand cars, the margin scheme didn't work. That was known to be something that would happen, and it wasn't fixed until after the event, which isn't good. There were food shortages as well, lots of issues, and then I has a very unusual status, which we'll touch on later. Regulatory issues have really come up as well, some non-tax. And of course, the killer blow was the filled sandwiches of the lorry driver at Rotterdam, where the customs officials, Rotterdam themselves, refused to allow him in with the sandwiches, so confiscated his ham and pickle. And basically, the reason for that is it was a product of animal origin, and you can't cross borders with that. So the phrase apparently was "Welcome to Brexit, sir." And he did apologise. Okay, next slide, please. So I'm going to hand over to Barbara. Thank you, Barbara.
All right, thank you, Sean, for my lovely introduction, and good afternoon, everyone. So as Sean has explained, the EU and UK finally signed that agreement, and it wasn't until Christmas Eve. And unfortunately, despite the government, despite HMRC, despite adverts and everything telling us that things were going to change, so many people believed that if we had a trade agreement, then nothing would change. And the changes have come as a huge surprise to businesses and individuals. So anyway, this afternoon, I'm just going to talk about the main changes, and then we'll come on to the questions. So the comprehensive trade agreement, not everything is covered in the comprehensive trade agreement. And we always knew that customs declarations would still be required for trade between the UK and the EU. An import is always an export. So as well as an import declaration to get the goods into this country, an export declaration is required to get the goods out of the EU, and vice versa. So 2 declarations are needed when goods are moved. Interestingly, in the trade agreement, it does say there is a work towards actually having 1 declaration to cover both sides of the transaction. But the EU is apparently not even going to start considering that for another year. So we have got declarations. We've also got rules of origin. So duty will apply to goods unless the goods originate and comply with the rules of origin as set out in the agreement. Now, rules of origin are in every trade agreement. They were always going to be in the EU-UK trade agreement, because these ensure that goods from third countries do not enjoy the same benefits as goods that have been produced in one of the contracting parties, in the territory of one of the contracting parties. You could see that otherwise it would just be a backdoor for goods coming through without payment of duties. So the EU duty rates, the duty rates that the EU will apply, are the ones that were applicable in the UK up to the end of last year. And you can see those on the EU's tariff website. So they're the rates that will apply going into the EU. But for the rates, duty rates coming into the UK, we now have the UK global tariff, which is very similar to the EU duty rates. In fact, we put the EU duty rates up, registered them with the WTO back in 2017, and said these are the rates that we will never go above. So we have actually reduced the tariffs slightly from what they were by liberalising some goods on which it was determined that actually duty should not be payable. Also by liberalising, reducing the duty rates on some goods where the tariff was in fact just a nuisance. You know, duty rates below a certain rate have been abolished, and they've also been simplified, so made into round numbers rather than 6.5 or 6.6% or whatever they were before. So they are slightly different, but they are the same in a lot of categories where we have problems, such as in textiles and clothing. So you can find the rates on the .gov website, and that will give you the UK rates. But also, if you look on there, it also gives you the rates for Northern Ireland. And I'm going to come on to Northern Ireland to talk about Northern Ireland. But Northern Ireland, because of the arrangements with under the Northern Ireland Protocol, Northern Ireland will apply the EU rates of duty. So you can also find the EU rates of duty by going on the UK tariff website and clicking on the Northern Ireland button. You will see the EU duty rates on there as well. So this does mean that if you import goods from, say, China and pay duty and then send the goods to the EU, you will be paying duty on them again, or the importer into the EU will be paying duty on them again. The Northern Ireland arrangements are not covered again in the trade agreement, but they are in a separate protocol. And I'll mention that at the end of my this talk. If we could have the next slide, please. The main thing that the trade agreement gives us are the rules of origin for trading goods duty-free between the UK and the EU. Under rules of origin, the goods have to be processed in the country. So if I am importing goods from the EU, they must have been processed in the EU. And there's certain operations that are in the agreement that say this processing can never confer origin. So operations such as relabeling goods in the EU or repacking or painting them would not confer EU origin on the goods. So if goods came in from Taiwan into the EU and insufficient operations were carried out, then the goods would be dutiable when they came to the UK. The rules of origin also say that simple assembly does not confer origin. And the description of simple assembly is that if neither special skills or machines, apparatus or equipment, especially produced or installed, is needed. So taking this as a UK operation, if you are only doing simple assembly on goods that you have imported, you cannot declare those as being of UK origin under the trade agreement. They may still originate in the UK for trade purposes, which are very different to the rules of origin that are in this agreement. And every trade agreement has different rules of origin. On top of the requirement to actually process the goods, there are also then for different products, different tariffs, it will list out, the trade agreement lists out what will be considered as a process to confer origin. So the first thing you need is the tariff heading for your goods, and then you can look in the agreement and it will tell you what is required. And it might be that if you have used imported materials, they must have changed tariff heading. An example of this would be if you import parts of dolls and made a doll in the UK. The parts of dolls would still have the same tariff heading. So the doll would not qualify as originating in the UK. If you imported the plastic to make the doll, the plastic would have changed tariff heading and your doll would originate in the UK. So for many goods, it's that imported materials must have changed tariff heading, but also for other goods, there is a maximum value of non-originating materials that can be used in the process. So for example, if you import bicycle parts and you produce a bicycle, you haven't simply assembled a bicycle, but you have made a bicycle, then the origin rule would say that those imported parts must not be more than 45% of your selling price. So different rules apply to different goods dependent on tariff heading, and you have to look at each one to determine whether your goods qualify. And these are just examples that I've used here. There are much more detailed rules, particularly in areas such as food manufacturing and textile and clothing manufacturing. If I could have the next slide, please. So if you determine that, how do you claim the preferential origin of a product? Well, you claim it at importation by making sure that you complete the import declaration correctly. And it can be claimed by just knowing that the goods originate. So if you know that the goods originate in the EU, you can claim the preferential duty rate. This is called importer's knowledge. The only problem with importer's knowledge is that at some point, somebody, HMRC, may come along and say, prove to me that these goods should have come in duty-free. What knowledge did you have? well, the best knowledge to have would be the origin statement from the exporter. So although the agreement allows you to have importer's knowledge, it's my advice to always get the origin statement from the exporter. And the origin statement is a declaration by the exporter that the goods do qualify as originating in the EU under the terms of the agreement. It's a specifically worded statement, which can be on the invoice or could be on another commercial document. But as long as it's evident, then the preferential duty rate can be claimed. There is a waiver from the need to supply formal proof of origin, in fact, to have that origin statement for small consignments, which for imports into the UK applies to any goods valued at under £1,000. So I read this as they're not going to ask you for those origin statements if you've imported goods under £1,000. The EU is not so generous. The waiver for imports into the EU only applies in very specific circumstances and doesn't apply to commercial to business operations. If you don't claim the preferential tariff at importation, and a lot of people have found that they haven't in the last few weeks, you may make a claim, a post-clearance claim for a refund of the duty within 3 years of import, which is quite generous. That's not normally in a trade agreement, so that was something additional in this one. Next slide, please. So the rules of origin, yes, as I say, should be on the origin statement, which could be on a commercial document with the goods, or it can be a long-term declaration. So if you were importing, you could ask your supplier to give you a long-term declaration, a declaration for 12 months, stating that anything that you imported under this specific goods description comes under the trade agreement. The difficulty with that, though, is that it might be missed at import. If the agent isn't aware that you are claiming that you have that long-term declaration, he may not claim the tariff preference, and you would have to do an adjustment later, which obviously is a bit of a faff. So I am recommending that you do put it on the commercial document, preferably the invoice that goes with the goods. For imports into the UK, the exporter must be registered on the EU REC system, and you can check that whether they are registered. We do not in the UK have a registered exporter system, and apparently it's not HMRC's intention to have that. However, if we have different trade arrangements with other countries, we may find actually that other countries will require us to have a registered exporter system. So we'll have to see how that goes. You must keep your records on origin for 4 years. And there is very detailed administrative cooperation details in the agreement. And this is the cooperation between the customs authorities in the EU and the UK, who will check that these declarations that have been issued by exporters are actually correct. So if you issue an export declaration to enable your customer to claim duty-free imports into the EU, you must make sure that it is correct, because at some point you may be asked by HMRC to verify that it is actually that the goods were entitled to that preferential duty rate into the EU. Next slide, please. So if we're importing, what has changed? Firstly, we have this system of deferred declarations for EU imports. This is a temporary easement, not to be confused with deferment accounts, which I'll mention in a moment. But this is a system of deferring declarations so that the declarations do not have to be made when goods arrive into the UK from the EU. It's a 6-month easement just to get us through this period, but it does mean that the declarations will have to be made later on in the year. In fact, 175 days after importation. So if you've imported something in January, you would not have to make the declaration until July. Now, the bonus of not making the declaration until later in the year is that if the goods are dutiable, you won't pay the duty until the declaration is made. So it's very favourable if your goods are dutiable, but again, I don't think it's really of no benefit if your goods are not dutiable. It's much easier to make the declaration and be done with it. Because to defer your declarations, you have to make what they call entry in declarants records. You have to keep an account of a lot of the information that would have been on the import declaration had it been made at the time of arrival. This is, of course, to enable an audit trail through to the actual declarations when they're made. But yes, this is only to apply for the first 6 months of this year for import declarations, and from the 1st of July, import declarations will need to be made when or before goods arrive, just like they do for goods from the rest of the world. If duty is payable on those goods, whether they're from the EU or from the rest of the world, from any country, you may defer the duty using a deferment account. We've all been used to deferment accounts, but they've been made a lot simpler for businesses to use by HMRC removing the requirement for a duty deferment account to have a bank guarantee, provided it is below £10,000 a month in duty. So if you import and you are likely to pay less than £10,000 a month, then you could have a duty deferment account without a bank guarantee, providing you're financially solvent and have no serious customs compliance problems. So that was duty deferment account. Yes, the other issue is postponed import VAT accounting. Following the introduction of postponed import VAT accounting, which enables traders not to pay the VAT at import, but to just account for it in their VAT return, in the next VAT return following importation, we have found that some people have unintentionally paid import VAT. You do have to actually ask the person making the customs declaration for you to claim postponed import VAT accounting. Otherwise, it will be paid at import. Because that is still an option if you really want to, you can pay and recover the import VAT as we used to. If you do that, you will still receive a C79 from HMRC. But if you use postponed import VAT accounting, you must also register on the through the government gateway to collect your monthly statement, which will be available online each month as a PDF. The first statement should be available, we're told, on the 6th working day of February, and on the 6th working day of every month hereafter. So you must sign on to pick up those statements. And the other thing about importing is that, of course, we do have other free trade agreements as well. The UK has already signed other free trade agreements, most notably the one with Turkey. But we've also signed what we call continuity agreements, which means that the trade preferences that we enjoyed as being part of the EU do continue throughout, most of them throughout the next 1 or 2 years until we have a new trade agreement with those other countries. So things may have changed for importing from those countries, but the tariff preferences should still apply. And that includes the generalised system of preferences, where the UK will still allow duty-free importation of goods from developing countries. But again, the procedures for that have changed if you're importing through the EU. So the next slide, please, should be exporting. No. Can we go back? We seem to have got the slides a bit confused.
Should be there, Barbara.
Okay, let me just talk on anyway. If you're exporting, an export declaration must be made before or when the goods leave the country. There is no easement on exporting. So those declarations are having to be made before goods move. Commercial invoices are therefore required. That seemed to catch a few people out. Actually, they now needed to raise an invoice when goods travelled between the UK and the EU. Obviously, that information is needed so that the customs declarations can be made. There's also obviously a requirement, if your goods do originate in the UK, to put that origin statement or give that origin statement to your customer, preferably on the invoice, because that's a very clear place and for the shipper to actually see it. But if you are the exporter, but you're not actually manufacturing the goods, you will need to get from your supplier in the UK what they call a supplier's declaration. So that will be your evidence that the goods originate in the UK and that you are able to give that declaration to your customer in the EU. It is suppliers' declarations that we have a 12-month easement on, giving people time to get those suppliers' declarations in place. So if you're exporting, you have got some time to get that declaration. But in the meantime, you can make the origin statement on your invoice, provided you know that the goods originate. And of course, yes, you have to make the export declaration, but your customer or the importer into the EU has to make the import declaration. And Sean's going to come on to that and talk about terms of trade with the customer shortly. So finally on Northern Ireland, just to mention that there are few declarations or checks on goods moving from Northern Ireland into GB. And they would only be on certain goods, for example, coming out of a customs warehouse in Northern Ireland or were CITES controlled. Very, very few declarations required. But declarations are needed on goods moving from GB to Northern Ireland, and that's for everything that moves from GB to Northern Ireland. And the declarations that are needed are the safety and security declaration, which has to be made before the goods move, the simplified declaration, just to say that the goods are moving, and then a supplementary declaration, which can be made up to the 4th working day after the goods have moved into Northern Ireland. Now, I hope traders are all registered for the Trader Support Service, because they are able to give a lot of support for businesses moving goods from GB to Northern Ireland. And that's both by means of webinars and information, but also they can make the declarations on traders' behalf, on behalf of traders. One thing to point out though, you need to be careful as to who is making the declarations going into Northern Ireland. Because if you've made declarations going into Northern Ireland, so far you would have only made the simplified declaration, and you're going to need to make the supplementary declaration. Because of the delays in the service, the supplementary declarations for January do not need to be submitted until the 4th of March. But at some time between now and 4th of March, you're going to need to provide additional data to TSS to enable the declarations to be made. And it's at that point that there will be a flag, if one is required, for additional duty. Because duty is payable on goods which are of non-preferential origin, moving from GB to Northern Ireland. This is because the EU duty needs to be collected on the goods because they may be at risk of moving into the EU. Now, if the Northern Ireland trader can evidence that the goods are not at risk of moving into the EU, basically through Southern Ireland, then the duty won't be payable. And to do that, the Northern Ireland trader needs to be authorised under the UK trader scheme. There is additionally, for people who are not authorised under the UK trader scheme, there will also be a system of waivering the duty, which will be up to Euros 200,000 in a rolling 3-year period. This is effectively under EU state aid rules. So provided you haven't had any, this is the state aid that will be provided, and is obviously only available if a company has not had any other state aid in the 3 years. So I'm going to leave it there because I think I've said plenty, and Sean can move on to talk about VAT.
Thank you, Barbara. That's great. For me, the whole new learning curve has been the customs piece. Whilst I've been a customs and excise officer, it's something I just dealt in VAT, and whilst we were badged up and had all the powers, it wasn't something we ever got into. So this is again back to that kind of world. And Barbara, there are a couple of questions, quite a few questions on the chat box. I'd like to maybe look at those in preparation for the Q&A, and I'd just like to confirm I'll circulate the slides to all attendees after the presentation is concluded. Thank you. Next slide, please. Okay, so VAT. As a tax advisor, and I've been doing this for 30 years, the exams we sit, you need 5 years experience, you study for a year, the pass rate is 34%. So pretty big ask, and we have been struggling with the changes. I think the volume of them has been difficult. We are working with systems in each member state. We are working with obviously the UK, and also the UK government decided to bring in new rules for digital services at the same time, which hasn't been particularly helpful. Goods, we're going to start off really with B2B. I'll talk about changes to services and then touch on goods B2C. There are some changes as a result of Brexit. There are other changes I mentioned which are significant for businesses, but mainly outside the sort of rest of the world, outside the UK. Okay, next slide, please. So the basic rule for me, the kind of starting point where I'm determining where VAT is due, is where does the title change to the goods. So if title changes in the UK, then that would be a domestic VAT transaction. The consequences of that is that you look at the VAT treatment in the UK, and if there's an export from the UK, then the UK VAT's due. So pretty simple. If there's a transaction in Europe, so title changes in Europe, then you've got an EU transaction and you need to look at the VAT treatment in that particular member state. And the key to that, if you're exporting or moving goods from the UK into Europe, is who is the importer of record. And a big issue we've had, and I've even dreamt of this, which is quite scary, is URI numbers. And it's a phrase we use all the time. I've actually put down what that means because it gets lost sometimes. You need an URI number to move goods from GB. So you'd have a GB URI number, and because we're no longer part of the EU, you need an EU number as well. And that might be a Northern Ireland number, because for customs purposes, they're part of the EU, and actually for VAT as well, although there's a dual status. Okay, next slide, please. So importer record is absolutely key. So we've been dealing with lots of clients, and everybody talks about Incoterms, and we've highlighted here just two of the main ones that come up. Incoterms don't actually determine the VAT or tax treatment. Those are commercial trading terms between the parties. What you need to look at is who is the importer of record. Now, under DDP, which is delivered duty paid, we would expect that to be the supplier, because you're delivering the goods with all taxes paid, so you would be the importer of record. Under DAP, delivered place or premises, then that would be the importer of record, would likely be the customer, and then all the obligations pass to them. So Incoterms are important, really important, but you need to look at the importer of record. That's going to be the key piece for VAT purposes to work out where the place of supply of goods is. Okay, next slide, please. We've moved away now from, as we've left Europe, we previously had dispatches and acquisitions. We no longer have that. We have exports and imports. If you import goods into a country, say France, then you're going to incur import VAT because it's crossed the border. So import VAT will be due subject to the normal rules. So if it was books, for example, and if France treated books as euro-rated, then there'd be no import VAT. But if it was a car, then the car would be subject to VAT. So you incur VAT on importation. You have an obligation to account for that VAT, and you will want to get it back. And that's that entitlement to recovery. And I have seen this go wrong so many times. A client many years ago tried to claim in Germany on a photocopied invoice. They lost £500,000 because of that. By the time they produced the original invoice, the time limit had passed. I've seen a US client lose £3 million French TVA, again, because they didn't have the right documentation, they didn't follow the right processes. So looking at importer record, looking at who has to account for the import VAT is really, really important. It's supply chain mapping. And in the UK, Customs or HMRC clarified their position recently that said only the owner of the goods can recover the VAT that's imported, and that's really important. So rules out agency. And if you have imported the goods, so you're the importer record, then there is an onward supply, so a domestic supply in that instance in, for example, France. So that would result in a registration requirement under normal EU rules. Next slide, please. So this really is just to illustrate what I've just run through. You've got a UK company, you've got an export which is zero rated from the UK. If you ship the goods DDP and you're the importer of record, then essentially you're making a supply in the EU and you need to consider the local rules. So is there a registration requirement or not? And there are some exceptions, which is why I caveat that statement. We would normally expect you to register. If you're not an established taxpayer, then there's no registration threshold, so that's not good news either. If you deliver DAP, then the customer acts as the importer of record, assuming they file the right documents. And on that scenario, that's the best of all worlds, where essentially the customer accounts for import VAT and recovers it as you would in the UK under our processes. So DAP is fantastic, it's really, really good. It is not necessarily, though, the best customer experience, and I have seen other advisors recommending everybody moves to DDP because again, customer experience is far better, particularly when you're dealing with individuals. That's all good, but that means 27 registrations across Europe, which is very onerous, very costly, and very difficult to maintain. And again, just on this slide, just to recap, if that's not due, then no VAT is chargeable. So if the relief supplies a 0 rating, an exemption. Okay, next slide, please. So I've touched on this already. So if you're making a supply in the EU, you have registration and compliance obligations, probably a 0 threshold, so you have to register for VAT. And if you just think about what that means, it may be that you register then in 27 member states, and we have some solutions for that I'll come on to. In the UK, what does that mean? Well, it means a registration, it means filing VAT returns on a periodic basis. Some countries require monthly returns, they require additionally quarter returns on top of that, and then an annual return as well. So the obligations have been quite onerous, and also we've got, as mentioned, MTD, Making Tax Digital. There are similar systems across Europe in some countries where you're going to have real-time data. So that's quite a challenge. You may also need a fiscal rep if you don't have an establishment in the country. So a fiscal rep costs somewhere around 3,000 per annum to have in place. And you require that because the authorities need some kind of anchor, some kind of way that ensures that you do comply when you're in their system. Touched already on import VAT. Some countries operate, as the UK does now, postponed VAT accounting, where you basically do a reverse charge or self-account on your VAT return. It's a fantastic facilitation. It works really, really effectively. But other countries still use the old import deferred accounting. It's where you have to account for VAT up front or slightly deferred and then wait. So you have a cash flow issue, and deferment accounts aren't necessarily cheap either. And as I mentioned, you would need a fiscal representative too. Okay, next slide, please. Some exceptions to the general rules on registration, which complicate matters. So in France, you would have potentially a reverse charge, a domestic reverse charge system in place, and also Spain. Belgium has a hybrid to make life even more complicated. And the issue that you then have is that you have no right to register in France, but you still incur an import VAT. So how do you get it back? So that causes an issue. Okay, I'm going to speed up a bit just to make sure we have time for a few questions. Okay, next slide, please. Good. So distance selling no longer applies because there's an EU mechanism. So if you now sell goods to B2C in Europe, then there is, if you are the supplier and responsible for the importer record, then you have to register for VAT in the customer's country because there is no threshold. So all the thresholds are gone. They were 30,000 up to 100K, and they've all disappeared. That's really quite a challenge. That's a big issue for businesses. Now, from the 1st of July, the EU will be introducing a one-stop shop, which allows for single registration for these sales for non-EU business. You have to register there. And that would allow essentially one VAT return, which is a huge facilitation. So really, really good news. But again, you've got that interim period before that becomes effective. The UK hasn't held back on introducing online marketplace rules either, which is not helpful because you've kind of got like a triple whammy of a new set of rules, which requires the online marketplace to account for VAT. And that does help, but it's just another thing for businesses to get used to. And then the piece I think that's maybe under radar is that there are new rules for goods that are actually below £135. If you were in the US, for example, and you sold goods less than £135 worth to a UK person, you have to register for VAT in the UK. And that's really counterintuitive. You wouldn't expect that. You'd expect it to be above, but it's actually below. I don't know how the revenue are going to police that. It doesn't apply to B2B sales, it's only B2C. B2B, you can have reverse charge, but there are obviously and always lots of conditions for this. It's really targeted at China and other countries where they're not competing very well with the UK businesses. They can undercut them. But I've seen, so these rules are in place, and I've had product delivered from the US and I've had product delivered from China. It arrives quicker now than from Germany. The values put on those products by the seller are false. It shouldn't really matter. They should be registrable, but nothing happens. So how they police that, I'm lost. But that's a big issue. And for UK companies, these rules come into Europe on the 1st of July. So if you're making sales B2C into Europe, you really need to think about how does that rule affect me? There's no threshold and the value is below £135. So a significant change under radar. And I think that's going to just catch so many people. Again, I don't know how the administrations will manage that. Okay, next slide, please. Services. Over the sort of 30 years of my career, every time there's a significant change, we would get a new public notice or guidance on the revenue. We've not had that this time. Very limited guidance. There are new rules for financial services which are beneficial. It means that there's increased VAT recovery when trading in Europe, which is really good news. There are exceptions, so some things haven't changed. So supplies in respect to land, for example, or where the land is based. Services can be complicated working out the place of supply, so where VAT is due. There are facilitations around the reverse charge. And from now, I guess one of the big changes is that if we were with private clients, for example, from the UK, then we would have accounted for UK VAT if the client was in the EU, so non-UK EU resident. That doesn't happen now. And what we're seeing is that law firms in particular are actually aggressively marketing in Europe on the basis they have a price advantage. So we're already seeing the UK being seen as a kind of an offshore planning platform that they can undercut their European competitors. That's not good. You see this a lot, and I've seen it 1,000 times in my career, but it's not going to help. You can end up with anti-avoidance provisions coming in. It's already being considered in Europe this quickly. Use and enjoyment provisions already exist. They're complicated. They've been changed now or widened because of our exit from Europe. And I think that's going to continue. That's going to be a theme we're going to see in VAT going forward, that these anti-avoidance provisions will come in and life will get more complicated. And I can see a point where a law firm will have to register if they've got a European client in France, for example, if their client's based there, because it's the only way really you can police this and keep it fair. And competition was a big point of the negotiations. And for them to act that quickly to almost abuse it is pretty shameful. Okay, next slide, please. Some other matters. MOS. So MOS is a members one-stop shop. It applies to digital services. You were no longer eligible if you're a UK business to join that scheme in the UK. So you have to join under a non-member state registration. So we typically go to UHY Ireland and our clients register there. If you don't use MOS and supply digital services, there's no registration threshold. That means, again, 27 different VAT registrations. MOS allows you to have a single registration, so it's really beneficial. Just one word of warning, 3 strikes and you're out. So if you fail to submit 3 returns, then you're out of the scheme for 2 years, which is really not good news. I've seen that happen to a small charity, so not great. EU reclaims, there was a mechanism before which made life much simpler. That's gone. So if you now incur VAT in Europe, you have to make a 13th directive claim. It has to be in the language of the country that you're claiming from. Onerous. For many years, Italy pretty much refused to make any repayments. Very much more difficult when you're in the club in Europe, so a different mechanism. But this mechanism is not great. So that's a real word of caution, actually, for incurring VAT in Europe. You really need to look at that. That can be really bad news. And then the other thing that's coming out of this from Brexit is regulatory issues and non-tax. We're hearing, obviously, about the political downside of Ireland and Northern Ireland and Scotland, obviously politically, but just in terms of business as well, there's a need for labelling, there's a need, I mentioned food already, there's a raft of different conditions that need to be met. And, we look at what we do. We're working in tax. I'm advising on VAT. I need Barbara to help me advise on customs, and then you move to the lawyers, and then you move. It's a big pot of issues for businesses to resolve. Okay, next slide, please. So solutions. So that's kind of the bad news and the depressing piece. Solutions. So government advice set up in Europe. Great. It is actually possible. It is obviously a solution if you're big enough, otherwise the ways around it. We need to take into account really the view of local administrations. So if you're registering in Europe, then they normally want you to have some kind of human and technical resource. Financial services firms 3-4 years ago set up in Dublin, and then the Irish authorities turned around and said, you haven't got anybody here, so why would we register? And they registered them, so put them back to square one. Supply chain management, if you're moving goods, don't bring them through the UK, if they're going back into Europe. Really simple stuff, but not easy to do always. Shippers offer some solutions as well. DHL apparently will ship in and take care of local compliance for you, but very expensive. Subsidiaries really help if you've got that in place already. Customs warehouse and free ports, this is where goods do not enter a free circulation, so you can have contracts and agreements and trade in those designated areas, and then wherever the goods are then entered into free circulation is where the tariffs and VAT will be accounted for. So a good mechanism, but I've not seen free ports progress, and that was actually something I think we need and will be a huge advantage to the UK going forward. Okay, next slide, please. Mitigation, just try and speed up a bit. So under the normal rules that I mentioned, the risk here is a UK business would have to register if it's moving goods and has customers in Germany, Italy and Austria, in all of these countries if it's the importer of record. So that's quite onerous, and again, if that multiplies across Europe, that's a lot of registrations, a lot of time, a lot of resource, and a lot of cost. So go to the next slide. So I've been working with a number of clients on is a fairly simplistic solution with a number of nuts and bolts to it. So if we have a UK business and we register them as a non-established taxpayer in the Netherlands or another EU country, then we have an export of goods from the UK, importer record into the Netherlands, and then we get back to the position we had pre-Brexit, which is where we have intra-EU supplies. So instead of 27 registrations, you end up with 1. That's really helpful. So UHY in the Netherlands have been helping us with this, as have other countries as well, France, Belgium, etc., and Ireland. That puts us back almost to where we were pre-Brexit. So that does facilitate trade. And again, we've kind of getting around the human and technical resource by having a fiscal record. We need one, but actually doing something there as an NETP, non-established taxpayer, gives you that kind of right generally anyway. Okay, next slide, please. So this is probably closer to my argument, legal background. The role of the European Court of Justice, so things that I've not seen mentioned. So the UK is extremely litigious when it comes to VAT. Not surprising, we love an argument. And I think also everyone has a different view on what the answer will be, particularly in my world. We lose the ECJ as a court of referral. The UK courts very regularly referred, and say we're probably the main user of the ECJ. And it was important because VAT's a European tax. And what we liked and had there was the purposive approach of the EU. When we look at the UK, it's very much a literal approach, so a different mindset. The EU is still important, the ECJ, because past decisions are still binding. Future decisions are going to be influential and give us a kind of steer, but we're not going to have UK cases anymore. So it's just going to be domestic. The only advantage I can see to that is really that one of the cases going for the ECJ took 15 years, so not great for the local authority concerned. And yet there's a lot to that, but yet it's an expensive and laborious process, and litigation is expensive enough anyway. But it is a really important court for us, and it will remain so. And then the other piece is flexibility. So we tampon tax, so that's been an issue. UK couldn't remove VAT on that because of European rules. It now has the ability to do so. There are a number of parts of the VAT system is dysfunctional. I've seen the Big Four charge £10 million in fees to the NHS through simple planning that really shouldn't be in place at all. The government should do something better to make it easier for the NHS not to pay VAT. And it can do that now, and I really hope it does bite that bullet and take that forward. That would be something really spectacular from sovereignty and make life better for all of us, really. Okay, next slide, please. So the summary on the VAT front, I apologise, I whistled through some of that. So goods is a key issue. That's the primary piece because we've got the interaction of customs duties. VAT is complicated. Importer record is absolutely fundamental to what's happening when you look at the treatment of goods. The £135 rule, if you export goods B2C, you need to look at what you're doing. That's critical. And then services, there are changes, and the FS intermediary piece, again, there's advantages there, and again, quite disgracefully, some of the big four are actually putting in claims going back for the transition period as well, saying it effectively changed last year, which was not the intention of anybody. And I think we need to play things really with straight bat, so work within the rules but not try to bend them, and that, because that really is what we need at this stage. That's it, I think, from the VAT slides. We go to the next one. Okay, so just a reminder that unfortunately the cameras aren't working, possibly fortunately. So if Barbara, do you mind picking up on some of the questions that were there, if you had time to reflect on them, and I'll pick up on one which we have emailed in?
Yeah, so a couple of questions. People are asking what's happening with Northern Ireland because they understand that declarations are not required for goods being sent to customers. What it is for express parcels, the express industry has been given an easement which will last until the 1st of April, whereby nothing changes, no declarations are needed for goods going into Northern Ireland if they are being taken by an express carrier. They are still needed. They are needed for goods going by hauliers, by trucking into Northern Ireland. So that's why people haven't seen those changes yet if they're sending goods, for example, by UPS or FedEx or DHL. So that's what's happening there. Things will change. Also, this issue on goods losing their preferential origin status. Yes, if goods come from the EU into the UK, they will be of EU preferential origin. But when they leave the UK to go back to the EU, they can't be declared of being of UK origin. So they lose their preferential status as being of EU origin, and they can't claim UK preferential origin. So this is typically the Percy Pig issue of coming in from Germany and then going out to Ireland. No duty into the UK, but the goods will be dutiable on going into Ireland. There is a workaround, but it's not very simple. It's okay, really, only if you are both the importer into the UK and the importer into Ireland. It would be using return goods relief, but you would need to disclose the original import of the original export of the goods. So it's not a great workaround, but it is something that people are exploring at the moment. Sean, did you want to pick something up?
Yeah, I think firstly, just to say there are a lot of questions coming through. So what I think we'll do is we will capture some of these and anonymize them, and then have some kind of frequently asking questions piece on our website, which will then have like hopefully you guys can refer to that. Just one question I think gets home is that this looks bleak, probably from my part of this. What's the advantage? I think there is something in the future that when this beds in, the government are right, people will get used to these systems, these changes. I think there is something around free ports, there's something around what the UK can do, and there's definitely something around flexibility that we don't have at the moment, or didn't have, that we can use during the VAT system. That is valuable. So there are pieces there that will come through. At the moment, we're kind of in the painful kind of transition. Which should have happened last year, and unfortunately that opportunity was missed. Just one question I'd like to pick up on, which was emailed in before actually, which is a great tactic. So the question was, if we were to receive an order from a UK customer requesting to deliver the product directly to their end user in the EU, who pays the VAT? Do we charge the UK customer VAT, So the goods are shipped into the EU, or do they charge the end customer? The answer to that is, so you've got a UK to UK transaction, but the goods ship out of the UK into the EU. So UK to UK, you've got direct export, so no VAT is due on that in the UK. But then you've got an import into Europe, so import VAT's due. The importer record will determine if you have to account for VAT in the country of destination. So again, back to, we've got an export, 0 rated UK, then you have to look at the European treatment because the goods have been imported and who is the importer of record. If that's DAP, importer of record is the customer, then they'll take care of all of the arrangements, all the VAT, all the clearances and everything else. That's great. But if you are the importer of record, then you have to account for the VAT and you have to be compliant. Okay, that was that one. Barbara, is there anything else? Just for over time now.
Yes, I think there's so many questions that I think.
Yeah.
I don't think we can. We've gone over time. Yeah.
Yeah. No, that's fine. Can I please thank everybody for joining today? Obviously, there's a lot more material and a lot more we could have gone into, and I apologise for overrunning. We will, as I say, take some of these questions and kind of develop a theme really for frequently asked questions, have that on our website as a point of reference. On the next slide, I think there are some sources of information as well. So we've got gov.uk transition, there's a questionnaire piece you can use which is interactive, which I think is quite helpful. There's a wealth of information as well, but it's really difficult to follow and doesn't give you a solution. The Europa website is the EU website, and again, quite helpful from the European side. Obviously, you've got advisors, there's a wealth of information, just check what you're being told because a lot of it does conflict. And on the UHY website, we've got a Brexit section. What we'd like to do, as I say, is we'll post and we'll kind of work out the themes for these questions and just put in some answers on there for you guys. And if you need advice, then we'd be delighted to help. Take it from there. Very, very grateful for your time. But Barbara, thank you so much for joining today.
No, it's been a pleasure. Thanks, Sean.
Okay, guys. So the webinar will be posted. You'll receive surveys as well. Hopefully you will respond because working with the Times is good for us, and we'd love to have your input into that. Please do feedback as well because we're keen to learn. And I wish you well in this brave new world. Thank you.